Hello, I'm James Leichter. In this video, I'm going to show you what I call the $100 bill overhead explanation. I've been doing this for a lot of years. It does a really good job of explaining to your employees, your staff, what happens to all of that revenue pouring into your company. The beginning of the video will be all about how to make the presentation, how to set up for it, and so forth. And then I will make the presentation as if I were doing it for your company or my own company from start to finish. And there'll be a link to that in the notes if you would like to skip to that part. To get started, you're going to need your company's income statement. Now, I would print an income statement for an entire financial period, such as all of last year, for example, or maybe 2 or 3 quarters. The more data, the better, up to a full year. Here, I have an income statement for our company. This is a real company with the real name taken off, so it can't be identified. But this is a real set of financials that I'm going to use for the presentation. Once you print the income statement, and I print the income statement including percentage of income, have that column included. Once you print the income statement, you're ready to start creating the prop that you're going to use in the video. And the prop is super important. You're going to build a $100 bill just like this. This is made with a Word document. It's a 3-page Word document. I printed out on a color printer. If you have a color printer, that's fine. Back before there were color printers, we printed it in black and white, and I got my young kids to color it in, and they thought it was awesome, and it looked pretty good. So either way will be great. Tape the 3 pages together like I've done here. Now, I trimmed the inside part of the pages just so it looks nice, but then I'm picky like that. Once you have this, it's time to take your income statement and get to work. Now we're ready to get to work. With our $100 bill in hand, we lay it on a table and we begin to write down the information that's in our income statement on the back of the $100 bill. And it should look something like this. I don't know how well you can see that. You don't have to read it, but it should look something like this. Each vertical line represents a major chunk of your company's expenses, your cost of goods sold, your overhead, and finally your net profit. So what I've done is I have started with my company's cost of goods sold on this side. Depending on your particular company, your cost of goods sold, your overhead items are going to be perhaps different than what I'm saying in this video, but you'll get the idea. I started with the biggest expense in the company, and that is equipment, serialized equipment. And then we have direct labor. That's the labor in the field for the workers that create the billable time. And then we have parts and materials and so forth. So each vertical line, each space between the vertical lines represents roughly the same percentage of the $100 bill as the expense. So I'll explain. Let's say equipment is 17%. 17% of your company's sales is equipment. Then roughly 17% of the total width should be that area, because you are going to want to cut the $100 bill down in proportion to the percent of that expense. As you'll see in the presentation, I've grouped these up and you should be able to follow along. On my income statement, I have broken down equipment, parts and materials, subcontractors, admin, employee expenses, vehicle-related expenses, and so forth. So it's pretty easy to translate that into the same proportion on the $100 bill. So let's get started. Keep in mind, we are going to provide a link to a download in the description so that you can download these files. I will provide you with the files to create the $100 bill. There'll also be a document that explains everything that you're seeing here, and you should have everything you need to do this. You're just going to have to print that income statement and write all over the back of it, and you'll be ready to go. One more thing I'd recommend is a nice big pair of scissors, shiny scissors, because remember, you are cutting up the $100 bill. You want them to see that revenue, that income coming into your company. You want them to see it being cut apart, dropping to the floor, and the scissors are the co-star in the presentation. Let's get started. What you're about to see is the presentation from start to finish. I won't break character to tell you how something works or whatever. I'm going to do the presentation as if I were doing it for my own staff or for your company. That way you'll have a good idea of how it all works and you can tailor it to fit your own needs. Hello, everybody. Welcome. Thank you for coming. I wanted to explain a little bit about our company's finances. I want to share with you our revenue, our cost of goods sold, overhead, net profit. Wanted to cover all that for you, and I thought I would do it by using this $100 bill prop that we created just for this purpose. What I have written on the back of this $100 bill is all of our company's expenses, where we spend our money and so forth, and what's left over. And with these scissors, I'm just going to go through all of the major things that we spend money on, and we'll talk about it. And hopefully we'll all learn a little bit. Whenever we have revenue, sales, and by the way, I'll share some terms with you when you hear business people talk about revenue and sales. For our purposes, they mean the same thing. You'll also hear the term cost of goods sold or COGS. Those are expenses that are directly related to doing the job, the service call, the installation, so it's parts, materials, equipment, things like that. And then we have overhead, sometimes called indirect expenses, and that's things like my salary, rent, liability insurance, etc. And we're going to go through all those, but now you know some of the terms that you're going to hear me throw around. The biggest thing we spend money on when revenue pours into our company is labor. Labor is the biggest expense. Now, in this case, it's labor for all of our technicians, our installers, everybody that works in the field, working hard in the field to produce this $100 in revenue. That's the major expense. As you can see, a lot of it is gone already. 19% of every dollar is for labor. And that would include the insurance related to that labor, the taxes, and so forth. Everything labor related. The next thing that we spend the most money on is equipment. 17.1% goes to equipment. That would be, in our case, furnaces, heat pumps, coils, anything with a serial number, that's gone. Now, as you probably could gather, there isn't much we can do to cut those expenses. When it comes to equipment, you're only going to get a slight discount, and the only way to save money on labor is to pay you less, and none of you want that, right? So there's really nothing we can do about any of the expenses so far. The next thing, parts and materials. So this would be replacement parts like motors, contactors, and things like that, but it would also be supplies, tape, screws, things such as that. Now, what we are left with is a lot less of that $100, and there's nothing we can do to change any of that so far. The next biggest expense when it comes to cost of goods sold is discounts. Occasionally we give discounts to make a sale. We give discounts to maybe satisfy someone who's complaining. But discounts make up 5.3% of our company's revenue. Okay, about 60% of the money's gone already, but it continues. We have one more cost of goods sold to talk about, and that is other cost of goods sold. It's the catch-all. These are things that are too small to be in their own category. So about 6% of our revenue, our sales, is other direct costs or cost of goods sold. And I'll read a few off. We have use tax at 2.6%. We have inventory shrinkage of 0.6%. Shrinkage, by the way, is a euphemism for it's gone and we don't know where it is. It's inventory that just disappeared, and I'm not blaming anybody for that. but it just disappeared. We have financing expenses, 0.02%. Not a lot. That's why it's in miscellaneous. Now, what is that, by the way? That's money we spend to finance our customers' fees. We have freight, 0.05%. Let's cut that off. What's left is about 34% of our $100 bill. And that is what we would call gross profit. After we have paid all of our costs of goods sold or direct expenses, whatever's left over is gross profit, and we use that to pay overhead. First thing is our company markets through various means, internet, etc. We budget 3% of that every year. So 3% of that comes right off. Now, by the way, 1.27% of that's just internet-related expenses. So that was marketing. 3% is the budget. The next big one is employee-related expenses. Now, these would be non-billable employees. These would be all of the people here in the room that support all of the people that are out there working hard in the field to bring in the $100. Let me give you some of those expenses. We have admin wages, administrator wages, 8.13%. Payroll taxes, again, payroll taxes not on the field, but for the office, the admin people, that's 2.1%. We have workers' compensation. It's just 0.1%. When you're writing the check, it seems a lot bigger than that. We have medical insurance, dental insurance, vision insurance, all of that, 0.52%. As a percent, it doesn't seem like a big deal, but that is a big number. We have paid time off at 0.41%. You're thinking, well, you ought to spend more on that. Doesn't seem like enough. But all of those things add up to a lot of money. Employee related. The next thing is building and equipment related expenses. Everything it takes to run our building. And let me give you some examples. We have property taxes at 0.27%, insurance at 0.66%, insurance on the building, etc. We have equipment expenses, 0.29%, rent, 1.2%, utilities, 0.15%, and so forth. It adds up to 3% of our revenue. Not too bad, actually, 3% of revenue to cover the building and our equipment. Next up, vehicle related. So when I said building and equipment, I wasn't referring to our fleet of vehicles, and that's 4% of sales. Repairs are 0.35%, licensing and registration, just 0.13%. Leases, we lease some of our vehicles, 1.02%. Fuel, 1.62%. That's the biggest. Insurance, 0.84%. All of that totals up to 4.12%. And that's what we're left with right there. There's one last thing we call administrative expenses. These are things that apply to the entire company. They're called administrative expenses. You get the idea. I'll give you some examples. Bad debt. This is money that we never collected. We did the work and they never paid us. Bad debt, 4.31%. Now that ought to make you mad. 4.31%. That's one of the biggest numbers you've heard. That's the biggest overhead item that you've heard so far. And that is the result of people not paying us. Accounting, 0.16%. Not a big deal, right? Bank fees and interest, 0.67%. That doesn't seem like a lot, but for us, that was $37,847.52 paid in interest. That's what we paid to borrow money. Cell phones and tablets, 0.4%. Insurance, not liability insurance, not building insurance, other insurance, 0.27%. Office supplies, 0.22%. We have legal and professional fees, 1.32%. We have rental fees. We rent some of our equipment, copier, for example, 0.26%. Security and alarm, 0.03%, not a big deal at all. Computer and software, 0.48%. Training and conventions, 0.82%. But that totals up to be 9.31% of our revenue sales. And that's what we have left over. We call that net profit. And this, as the owner of the company, is what I get to put in my pocket as a bonus at the end of the year. And for us, that's a big chunk of money, and I really appreciate it. But actually, that's not how it works. Let me get that money back out of my pocket, because there's more to the story than that. We still have to pay taxes. Now, I'll share with you, our net profit is $227,483.61. That's a lot of money, isn't it? But that's only 3.6% of revenue. But that makes us 50% better than the average company like ours. So congratulations, I do appreciate that. That means you are exceptional. Our profit is exceptional. But just think, we don't even make 4 cents on the dollar, and we are called exceptional. But that is very good for your average company. 4 cents on the dollar is pretty darn good. $227,483. The reason why I don't get to put that in my pocket as a bonus is because we need it for growth. We are going to need to hang on to all the money we can, because as we grow, so do our expenses, payroll, etc. And we have to keep that money in the bank and hopefully grow the bank account. One thing I mentioned to you before is interest. Somewhere on the floor is interest. Let's find it. I found it. Let's go back to that interest and just have some perspective here. I'm going to cut the sliver of interest so we can see it with perspective. That was it. That little sliver is the interest. But that was $37,847.52. The reason why we had to pay interest is because we had to borrow money, and we had to borrow money because we didn't have enough money. That's why it's really important that we never give the boss, the owner, this money. We hang on to it because we're already borrowing money from the bank just to meet the bills. I also said this is before taxes. We have taxes to think about. We have federal taxes. Now, our company is in a 32% tax bracket. When you get to $227,483.61, you are in a 32% tax bracket. Now, the whole chunk of money isn't taxed at 32%. For us, it averages about 27%, but 27% is a big part of this. So let's get rid of that. We have state tax, 6%. Let's get rid of that. We have FICA, 6.2%. Get rid of that. We have Medicare, 1.45%. Maybe that's about right. And we have self-employment tax. This is the other end of our FICA. I have to pay, but it's just the same as you pay. You pay half the FICA, I pay half the FICA, but all of our earnings, I pay all of the FICA. So let's get rid of that. That's what we're left with. We're left with a net profit of about $97,000 after taxes. So we keep that $97,000 and we go to the bank and we borrow from them to cover the rest. Now today, I asked our controller to join the meeting, and she's been sitting up here to my right, front of the room. I've asked her to bring what we call the balance sheet. A balance sheet is a financial report, if you didn't know. And on that balance sheet, it lists your assets, your liabilities, and whatever's left over. One of the things on that balance sheet is what we call accounts receivable. That would be money that is owed to us by our customers, but we haven't collected on that yet. So these are jobs that we've completely finished. We did what we said we were going to do, and they haven't paid us. And by the way, if they don't pay us, it turns into that bad debt I mentioned earlier. I was going to ask her, if you would please, share with us the accounts receivable on the balance sheet. Just give us the dollar figure. Okay, $227,383 and some pennies. So we have almost $250,000 owed to us. We have only $97,000 left after we paid our taxes. There's a shortfall there of let's call it $150,000 that we have to pay. And that is the reason why I can't put that money in my pocket. That's the reason why I have to go to the bank and borrow another $150,000. That's the reason why next year I'll pay more interest than I did this year, most likely. And that's called cash flow. And in our case, the cash flow is negative. But that is the topic of another presentation, which we'll get to at another time. So that's the story of what happens to $100 in revenue. It doesn't matter if it was 100 million, a million, 100,000, big company, small company, you will have all the same bills and expenses in proportion as we do, roughly speaking. The numbers will be just higher or lower, but the percentages will be nearly the same. All right, I have one last point to make, so bear with me for a few more minutes. Let me go back and grab my net profit. Here it is, 3%, better than the national average. Thank you very much. That's all your hard work, and I do appreciate it, but it's not much. And I want to put that into perspective. When we do $100 in sales, that means that what we have left over before taxes is $3. So if you were to run a $100 service call, we're only making $3. But if you drop a pipe nipple on the ground and don't pick it up, then there goes our net profit. And that would be called inventory shrinkage. Remember that? That's how tight it is when your net profit is only 3%, which is still better than the national average. So you run a $500 service call and we make 3% on that before taxes. That's $15. $15 before taxes. Now, what happens if they don't pay it? They don't pay the $500. We'll take 500, divide that by 15. I'm not smart enough to do that in my head. That's how many service calls you'll have to run to make up for the $15. You'll have to run that many service calls. And once you've done that, the next service call, you get the $15 that you would have got all those service calls ago. That's how tight things are when you're a 3% net. I hope this presentation was helpful to all of you. Truly, my point was, we're not filthy stinking rich. I'm not filthy stinking rich. Even though we're better than the average, we have a lot of work to do and we have to be very careful. We have to be very careful about efficiency, bad debt, inventory shrinkage, etc. We have a great future ahead of us, but at 3% net, it's easy to make a mistake that we can't cover. So that wraps up my $100 bill overhead explanation. I hope you have a better grip on what all that means. Thank you very much. Hey, if you got anything out of this video, I mean, just like 3% of it helped you, would you please consider liking the video? It helps us out with YouTube a lot. And also subscribe. That way you'll get notifications when we post new videos like this one. Okay, sorry guys. What are the odds? Everything fell face down. Okay, here's the interest. I hope you don't plan on including this. I'm not wearing shoes. All right, I got it, you guys.